Good evening, everyone. My name is Dina Ghanma. I am a second-year undergraduate finance and investment banking student at the ICMA Center. Thank you all for being here tonight, and a special thank you to the panel who put me through to the finals. I really hope you enjoy my presentation about this pressing topic of short-termism. So in my 10 minutes, I am going to cover what short-termism is, whether or not it is really a problem, and if so, how bad is this problem? And finally, can we fix it? The textbook definition of what short-termism is the tendency to focus attention on short-term gains, often at the expense of long-term success or stability. But I like to think about it in much more simple terms. Basically, it is hitting the snooze button on your morning alarm. On the short run, all you want is a little bit more sleep, while on the long run, you know that you might end up being late for work. In reality, many of our daily habits are short-term focused, but the question is that a bad thing? At the request of the panel, I have included parts of my submission video to introduce my point of view. So here it is. One of the first lessons we learned in finance is that a long-term investor demands a liquidity premium, in exchange for them trusting us with their money for not weeks or months, but years into the future. We reward them. Nowadays, however, it seems it is the short-term investors we seek to please. It has literally become the objective of most firms to focus on today, this quarter, while turning a blind eye to the long run. Firms can alternatively aim to maximize growth, sustainability, and/or customer satisfaction. But a true capitalist would ask, what would be best for the market? Then again, should we be true capitalists? It's a debate, perhaps a notably skewed one, but nevertheless a debate. And with that said, let's look at both sides of this debate. Is short-termism bad, or is it in fact good? The obvious bad thing about short-termism is that it hinders growth and development, weakening innovation and creativity. If we are forced to keep looking at the short term all the time, how far can we really grow? What if nobody gave companies like Facebook or Lego a chance to develop their innovation and become the giants they are today? Where would we be as their customers, and more generally as people even, without startup firms that did not seem likely to succeed at first? Short-termism would have killed these companies. But it is also very important to remember that investors' short-term demands are not always for the return itself, but rather information that might indicate return will soon be made. And it is this persistent demand for information that is in itself a very big advantage. It forces problems out in the open sooner and allows us to solve them more easily. Just think of how much worse the Tesco accounting scandal would have been if Tesco weren't forced to report back to us every few months on its performance and position. Also, whenever we want to say something is bad, we must look at the alternative. And many agree that the alternative to short-termism is the obvious long-termism. But is long-termism great? One writer describes it as an inescapable reality, that firms must invest in their future if they are to have one, but they must also produce earnings today in order to pay for doing so. Basically, it is a classic what came first, the chicken or the egg scenario. Invest in the future, which is long-termism, or avoid the risk of not even having one, short-termism. Let's look at a slightly dramatized version of what could happen if a firm has a long-term strategy. Say it wants to invest part of its profit in research and development. Obviously, the accounting metric of earnings per share will fall, and investors usually have targets for these, and they scare very easily. So if that target isn't met, investors will sell. Introductory economics tells us that supply will go up, demand will come down, and price will fall with it. The company will lose value. And if it loses just enough, it might actually end up failing. And at that point, we wouldn't have to worry about the future because this company wouldn't have one to begin with. But let's be realistic. We can't keep hitting the snooze button forever. Just like we can't keep fooling ourselves in the morning, companies can't fool the markets forever. There will come a point in the so-called future that we will look at a company that hasn't invested in itself and say, you have nothing to offer us. And not hitting the snooze button is simply, hitting the snooze button continuously just isn't sustainable. Let's be a little bit childish and point some fingers. Is it management's fault? In a recent survey, 73% of interviewed board members said that a business strategy should last for longer than 3 years. And a very large majority, at 86%, agreed that a long-term strategy would have positive effects on innovation, development, and even shareholder return. But then, surprisingly, almost half, at 44%, admitted that their own strategy was for less than 3 years. So why don't they practice what they preach? They control the company, don't they? But the more important question to ask is, who controls them? And the answer we all know is owners, investors. We also know that they are not a patient bunch of people. But just how impatient are investors? In the 1960s, the average holding period for stocks by investors was just over 8 years. Into the future, it kept falling until in 2010, it was as low as 6 months. And today, most shockingly, it is a mere tiny 5 days. Basically, we are saying that owners own their companies for less than 5 days at a time on average. If that isn't short-termism, what is? So now that we've established it is a problem, let's be a little bit more optimistic. What solutions do we have? The number one thing that needs to happen is that someone needs to take a big first step. And who better than the most influential investors out there? Pension funds and mutual funds. It is reasonable to assume that if they start looking at the long term, many will follow suit. Also, it is important for companies to target the right investors for its ambitions. Take Dell, for example. When it knew that it needed time to restructure itself if it were to continue to compete in the big leagues, it went private. Simply, it knew that the public market was too impatient and was not its crowd. And lastly, and most importantly, in my opinion, companies need to go back to basics. Revenue. Revenue is really the only continuous stream of funding into a company, and it relies almost solely on making a good product and providing a good service. I went around campus and on social media asking people if someone randomly gave you £100 and told you to invest in whatever company you wanted, what company would you choose? Most people said things like Burberry, Google, Apple, Ted Baker, and even a large number said Nutella, which is actually part of the bigger Ferrero. And the reality is, the reason for this is simple. These companies made their customers happy and kept them that way. So if a long-term research and development strategy is what a company needs to employ in order to ensure customer satisfaction, then so be it. Long-termism is the answer. And finally, to wrap up, I would like to quote a famous business saying, which I tweaked a little bit. It's customers who are always right, not shareholders. Thank you.